Good evening, everyone, and thank you very much for joining us tonight. We've called this session the Options Masterclass of Better Not Disappoint. Well, that's what the marketing people called it anyway, but it's an opportunity for us to get together. We've got a couple of people online tonight, so a bit of a panel conversation about some of the trades we're seeing in the market. I've got Tim here who runs the education side of the business, Ivan from Trade Floor. Hello, Ivan.
Hi.
He's probably muted himself there. And Graham O'Brien from the ASX, who's the manager of derivatives.
Hi, Patrick.
Now, so thanks, guys. So we're going to go through a couple of things. We'll probably start off with Ivan in one moment to have a look at the game and where we're up to at the moment. We're then going to have a look at some of the trades that are presenting themselves in the market and have a look at some of the opportunities and what trades have been working well. It's been an interesting sort of market for the sorts of trades that I look for from a directional perspective. There are some trades approaching, but there hasn't been anything that's broken out. So I've been sitting on my hands a little bit, but Tim's been beavering away, trading away. It suited his range trading style beautifully. And there's been plenty out there, for traders. So we'll go and have a look at that in a moment. But any advice contained in tonight's presentation is general only. It doesn't take into consideration your personal circumstances, and you need to decide whether it's appropriate for you. Past returns are not an accurate indicator necessarily of future returns. All right, guys. Well, we hope you're enjoying the game. We've had record numbers booking into this game. Ivan, do you want to, have you got control of the mouse, or do you want to drive me? Where do you want me to go?
Yeah, maybe I'll just drive you. Look, I just went quickly. Let's go to the leagues, and you can sort of see the overall leaderboard. In the single week, Philip Crawley ended up overtaking everybody. Started this week, and he's straight into first spot. So it sort of goes and shows that just because we're getting towards sort of the middle of the game, towards the end of the game, it doesn't mean that you can't participate and you can't win. I'm going to quickly go through some of the trades that the top players have done. I do like to see Tim, Belinda and Blake still being in the top five. So they're clearly, they were there. For those of you that were with us last week, they were there in the top five last time. So it's great to see some of the locals doing quite well. Also, I quickly want to just spend 2 minutes on talking about buy rights, covered calls, cash secured puts, because that's something that came up a lot. Maybe towards the end of the conversation after Graham does his presentation, we've had a lot of questions about that. So Phil Crawley, the trade that he did that really did the best for him was CSL. So maybe if you can bring up a chart of CSL, that could be a good starting point. So the thing that I liked, the 2 out of 3 guys that I'm going to be talking about is they're both traded spreads, which is again typically something, even last week we looked at a lot of people putting on puts and calls, bought puts, bought calls, and just a reminder for those of you that are just starting, you buy a call when you think the market's going to go up, you buy a put when you think the market is going to go down. And we had a bit of a bounce last couple of weeks, last week in particular. So CSL, it was a bullish call spread, made 65,000 on it. It was a decently sized trade. 234, 240 was a spread, and that was entered towards the end of last week. So market obviously bounced over the last 3 days, broke out from the 240. So a great trade. Now it's just expiring towards the end of the month. It can't get much better than that. Also a straight call on STW, and that's maybe the next, if you can bring that up. So the STW is an ETF, which is a spider ASX 200. It tracks very closely to the overall index. The other way to get exposure to that is obviously the XJO. The reason why people, we had this question last week, if you missed it, why do you trade STW versus XJO? Well, you can lodge STW as collateral would probably be the best reason as to why you would trade STW. So if you own the ETF already, you can do things like covered calls, you can do things like cash secured puts with it, whereas the XJO is just cash settled. So just depends on how you form your structure of your portfolio. But a 60 strike December call, so a little bit later, a little bit longer term, and that's yielded 14,000. So although the rise hasn't been that much, I put that on to around about when it was around about 60. It's obviously up $1.60 from there, roughly, probably about $1 since you put it on. A great return, especially in light of how much size he put on there. The other trade, so that's the weekly winner. Congratulations, Phil. Tim, if you can contact him with some trading vouchers, brokerage thing that you guys do.
For sure.
Joel was the other one. He popped into 6 to 7 to 8 spots, something like that. And he also did this with STW, and he did it with a spread. So it was a 61-63 call spread, $30,000, bigger position. So that's still, that's right in smack bang in the middle of his expected range. If by the end of October it goes up to 63, he'll actually significantly further profit on that trade. Elias, sorry, whichever way you pronounce your name. ANZ was the way that he made that. So that's the last trade that I'll look at. He's jumped straight into 7th spot. Straight call on ANZ. Great timing, straight at 27, picked the low. Obviously right back into the middle of that range. So another great trade, well timed. So as always, for a lot of the game players that are doing the best, they're taking a view on a directional position, and then they are committing quite large volumes to it. The other one, just as a general notice of the leaderboard, if you can maybe go back to that. You can't see it actually. No, so number 6, just behind there is Vin, guy who's played probably our game, must be 3rd or 4th time, and consistently in the top of the results. So another great performance. He was on the top of the ladder last time for about 2-3 weeks until he got knocked off right at the end. So great performance there as well. So guys, keep it going. I'm hoping that watching people now doing spreads is because they're watching the videos around about the 3rd or 4th video. There's 10-minute videos that come through in your inbox where you get to listen to my wonderful voice talking about options. We talk about spreads. So it sounds to me like, looking at the whole construction of the book, a lot of trades have moved to that, and I hope that the people that have traded them and tried them out in the game have seen the benefit of spreads in directional trades. So it was good. I'm really enjoying seeing how these games change over time in terms of strategies. What do you guys think?
Beautiful. Yeah, look, and I think from a trade idea perspective, our scanning technology, which is in the game looking for trades, hasn't produced a lot. There haven't been a lot of breakouts. Obviously, we've been, a lot of things have been sort of ranging a little bit. CSL has broken through. I mean, it lines up in a lot of ways in terms of it that, it's broken a 52-week high. There's a golden cross on the moving averages, and the moving averages are trending up, and then the share price is above the moving average. So usually it would line up. But probably the thing that is a bit low for us at the moment is the ADX. That would be the one thing that would have knocked that trade out of contention. But other than that, it's lined up quite well. Coles has been sitting there threatening to produce something. It's been, like CSL, there's been lots of trades, long trades on it for quite some time, and it's produced a couple of trades for us recently, but it just hasn't quite made it above that 50, 15, 57 level, which I think we're looking for that 52-week high to break, and James Hardy was the other one on the long side of it. But other than that, not a lot from our scanning trades. I think, Afterpay had got pretty close. Why don't I bring that up and have a look? APT. That's right up there now. So that actually, for a very short period of time, maybe not long enough for you to be able to get into, presented itself. And the only thing to maybe have a look at there is how far away the stock price is from the 50-day moving average, which is, for those of you that trade with the lit long method, the point where you would reverse it from a long to a short position. That would be a significant loss down to that level. But other than that, it lines up. But that would be something that would probably hold a lot of people back at the moment from wanting to go after that trade. You'd have to be pretty confident it was going to go for a run.
Also got to have a look at the liquidity a bit as well. It is a fairly illiquid optionable stock at the moment.
Yeah.
So it can hold you back from getting the price you want entering and exiting the position.
Yeah.
Not in the game, Tim. Not in the game.
Not in the game. But yeah, you'd be needing to trade right at the money, I would say, to have a chance. What else have we got, Tim? So from the trades that you've been looking at, and Tim's coming second in the game. Unfortunately for Tim, he's not allowed to win any of the prizes, but he's trucking along very nicely. So what's been the secret of your success?
I've been doing a lot of range trading, and the market just has been very, very nice towards range trading over the past, basically since the beginning of the game, over the past 2 weeks. It's been very lucky, and right now I'm struggling to find trades because everything's right in the middle of its range. So it could go up, it could go down, and as always, it could go sideways. But there's a few that I'm looking at using the same strategy, which did offer a bit of potential. And it's always feel a bit uncomfortable betting that Macquarie Bank's going to fall. But in terms of trading a range, it looks like it's hitting a resistance level where it is a very strong and recent resistance level. And when it has previously hit that resistance level, it has been a bit slow to turn back down, but it does, at least recently, turn back down quite quickly. So that's what I'm hoping for. I have put a put on Macquarie Group. And next one is NAB out of the four big four banks. This is the only one that really seemed like it was still at the lower end of its range. The other ones were in the middle. And this one looks like it's just started to bounce off its 50-day moving average. And it has had a period of growth along this diagonal line across here where my mouse is running, basically from the beginning of 2019. It's been up and down, but mostly with a bit of a upward trend. And recently it has been going a little bit higher when it does bounce back. So I'm hoping for a quick rebound on NAB. So I put a call on that one. Looking at another favorite, Newcrest Mining. This one is one that has performed very well with our lit trades and is now looking at just range, running around the range of around 33 to, I believe it's around the 36 mark, and or 38 mark. And what I'm looking at here is the stock Newcrest hitting the support right at the bottom here. It has been a bit of a strong support level back here, and then in recent times over the last 2 months it's just bounced back up every time it hits it. So hopefully that's a quick win. I put on a call on that one. And this is another one which I'm not really sure about, but I'm hoping it will work out. So it's recently traded within this range. It is right at the peak of its recent range of with a resistance level right on $8. I'm hoping that's just going to fall back down at least to the 50-day moving average. I'll probably take out the profits from my put as soon as it hits that 50-day moving average, or at least gets close to it. I don't see this one, if it's going to be range trading, necessarily getting through these two resistance lines quickly and then all the way to the bottom. I think I'd rather take the money out and put it in something else that will present itself at the time. And this is the last one that I've been looking at and got into today. This one I don't really have much of an idea where it will go from here, Santos, but I have put a put on it. So there was a merger that was approved yesterday, and the stock price did jump quite a bit and it's pulled back quite a bit today. And basically what I'm looking at here is maybe for it to come back to where it originally was before the merger was announced. So I haven't really looked into the merger at all. I have no idea what's going on there, but often that's the way that things will turn out. If there's a merger that will be announced, the buyer might suffer while the company being bought usually gets a bit of a benefit and a bit of a premium. But we'll see what happens. They have been working closely with that company for a long period of time, so it could continue going up, in which case I would lose my money.
All right. So Paul's made the comment, Tim, you must have a strong ticker. Well, I guess the environment he's trading is within the game, but I will say that last game he almost won that as well. So he has got a pretty good feel for the market. But again, when we're trading in a game, we can do many more trades than we would normally do. We can do much larger, and we don't have the psychological challenges that we have to work our way through when we put real money into a trade. So that's the benefit, and I guess the idea behind all of this is it gives you the opportunity just to play around, practice putting trades on, test the methods that you're using. We mentioned this last week. There is a backtesting module in there as well, so you don't have to rely on the market being open. You can go back and have a look at any trades at previous periods of time and practice those trades and go through and line things up and put trades on that way after hours as well. All right. Now, so that gets us through having a look at the game, having a look at the trades, and probably brings us to what we wanted to go in and have a look at, and what we've invited Graham. Well, look, I guess Graham volunteered a couple of different things that he could talk about today, but really what we were keen to hear from Graham was what are the most common trades people are doing. What's the most common uses for options in the market? Now, interestingly enough, I know that, and this is something that I've spoken to Graham about before, that the most common use for options in Australia is by people using them within their portfolio, or funds managers using them within their portfolios. We had Kieran O'Callaghan last Tuesday come in and talk to us and share some of the strategies that he used around Brexit and Trump, and would commonly use to generate some returns when there was high volatility in the market or risk the market would fall, and also some of the ways that he would generate additional income. And there were a few questions about that, and it was all very high level. So we thought we'd do is ask Graham if he could run through some examples of these particular trades and talk through some of those slides as well. So Graham, I'll welcome you back online. Now, I'm just going to click, I'll go through these what are options slides. I left them up purely because we haven't actually shown a slide of the stocks that you can trade options on. We have shown you, though, if you ever want to go and have a look at what the optionable stocks are, you know that you can go to the stock screener, and that will show you the list of all the optionable stocks, their implied volatility, and their the liquidity on them. We're showing a thumbs up or thumbs down based on liquidity. But these are the stocks, so I thought I'd leave that slide there. And I think what I might do, Graham, is just bring you straight through to the strategy we were going to, what have I done here? Excuse me. Let me click through. All right. Graham, are you online?
Yep, sure I am, Patrick. So you're exactly right. It's the major reason people use options is in conjunction with their share portfolio. So a couple of trading strategies that we see clients employing, one of them is about building protection into portfolios, whether it be a GFC like protection, or even when we looked at the beginning of last year, some significant falls in the marketplace of how people might go about that protection. The other trading strategy is about generating income. It's all about using calls to ride over stock that people are owning to try and generate income streams when the markets are range bound, as you were mentioning. We are starting to see spread trading that both Ivan and Patrick spoke about a little bit earlier, but definitely these are the two most popular trading strategies we're seeing. Might touch on the third one that we're starting to see evolve in the marketplace, which is after you get caught away on that stock when you write a call. So first of all, when we think about protection, I always like thinking about insurance when we're thinking about protection for marketplaces. And when we buy put options over shares that we hold, it's like buying insurance over your shares. And I know back in the global financial crisis, there was a number of different alternatives that people would implement to protect themselves against the significant falls that happened in the market. So some of those alternatives were do nothing And unfortunately, that's what most of us did during the global financial crisis. We kind of prayed that the stocks would rally. To some extent, they did, but it took many years for them to get back to the levels that they originally were. You could have shifted to sectors with better performance. Generally, when markets are under pressure or the economy starts moving towards a recession, we go to more defensive style assets, but every single sector took a massive hit during the global financial crisis, so that really wouldn't have helped us at all. If you thought the market was going to fall significantly and never recover, selling stock and actually putting your money in cash was probably the best alternative that people could have done. People could have placed stop-loss orders with their brokers, but we all know what happened during those big volatile events in the marketplace. You go to bed at night, the ASX market would be down a little bit, and then it would open up the next morning and open down significantly further. Stop losses don't protect you from gapping markets overnight. The only thing that can protect you is things like buying protection through the options market. Have I got control of the slides here, Patrick, or if you can click on to the next one?
If you try moving your mouse and clicking.
Okay, great.
Yep.
If we implemented this portfolio protection, importantly, if you use options, you can still return cash to offset the capital loss in the portfolio. So the style of protection that we're seeing both funds and investors utilising is they're actually using index options, which allows them to hold on to their portfolios, not having to sell any stock, but getting cash back for what the value of your portfolio might have lost. Importantly, for those people that hold self-managed super funds, you can continue to receive your income of both the dividends and those most important franking credits. Importantly, protection is only used when the market falls, and you can continue to benefit when the market rises. I'm trying to move that mouse, but I can't really move to the next slide. I might just call out to you, Patrick, and we'll just click on the next slide.
No problem at all. Yep.
The chart that we're looking at here, we can see that, that back in 2015, late 2015 into 2016, there was a significant fall. Obviously, there's been more recent falls. There, towards the end of last year, we saw falls. But we're going to use the example back in 2015 to give an understanding of how you might protect against a very large fall in the marketplace. So across to the next slide. And we can see that the market at that point in time was trading at 5,950 points. So that was back in April 2015. Index options trade at $10 per point. So if we had a $59,500 portfolio, if we protected our portfolio at 5,950 points, use one option. So if you can just click again for me, please, Patrick. And we will notice about another market correction. So we'll just keep on clicking. We go to the market, we buy one index option. At the point in time, back in 2015, that option was worth around 100 points or $1,000 to take the $59,500 portfolio. We go to the options market. The very first negative that happens is that we actually incur a cost for buying these options. Just the same way as when you buy insurance on your car or your house, you have to pay an insurance premium. When we're buying insurance on our shares, we have to pay an insurance premium, which is the cost of the put. The unfortunate thing is it raises our break-even. In this case, we need the market to actually rally above 6,050 points before you would be profiting on your share portfolio. Next slide. So let's have a look at what would happen at different points in the portfolio. So we can see if the market rallied above 5,950 points, we wouldn't want to be protecting our shares because the market's rallied, the puts will have expired worthless. We can still benefit from profits. All that you would lose is the $1,000 that you paid for that option, and hopefully that's offset by any gains that you make in your stock. If, however, the market was to fall, we don't liquidate our portfolio. Instead, the options market's going to pay you back $10 for every point that index fell below 5,950, ensuring that we limit our loss to that $1,000 that we paid for protection at the outset. Let's have a quick look at different points along this chart to see what the effects would have been on our portfolio. Now, I know that the index did fall down to around 4,970 points by the time September rolled around back in 2015. Effectively, you would have had a $10,000 loss on your portfolio, but the nice thing is the options market will have actually paid you back $9,000 after that $1,000 cost. Overall, you've lost $1,000. 5,042, not 4,970, sorry about that. The next point, if we look at other areas that the market might have actually fallen to, we can see that if the market only fell 500 points, $5,000 loss on our share portfolio, options market pays us back 4,000, total loss, once again, maximum $1,000. The market didn't move at all. What if the market actually remained steady at 5,950? You might have picked up a few dividends, a few franking credits, but you still incurred the cost of that option. So you would have actually lost $1,000 ex dividends and franking credits. The beauty about options, though, is they protect us against the downside, but they still allow us to participate in profits. Market rallies 500 points. Stock market would have gone up 5,000. We would have lost that $1,000. Still made $4,000 overall in a paper profit on those particular trades. As the market continues to rally, would still profit as the market rallies. So the benefit of that put protection strategy, it does act like an insurance, but it can be costly, $1,000 or 2% of the cost of our portfolio for 6 months worth of protection. So if you were insuring your portfolio all the time, it costs you at that point in time 4%, and the insurance does expire. That was back in 2015. What about some more recent examples? So market volatility has actually rallied up. Back in 2014, 2015, it was around 9.5%. I know Ivan and Patrick talk about volatility a lot in our market. It actually rallied up in September to 14%, which increases the cost of our put protection. So that 6-month cost that we had before, which was 2% for a 0% access and at the money protection, now costing 3.4%. So it's costing you close to 7% of the value of your portfolio to buy at the money protection or protection without an excess. Same way as if you build an excess into your car insurance, your home insurance, you're actually happy to pay some money before you claim on that insurance policy, you can reduce some of that excess. So a 6-month policy, if we're happy for the market to fall, or we're comfortable with the market falling 5%, could reduce that cost for 6 months down to 1.5%, or 10% down to a half percent. We're seeing most funds and private investors not buying at the money protection. They're more buying disaster insurance when they buy put options from the market. So they're looking somewhere between that 5 and 10% down to reduce the costs involved in buying put protection in the market. So that's our put protection example. If we start thinking about the second, or it's actually, they're equal, most popular, another very popular option strategy is selling calls over stock that is owned. And a lot of people do this, even fund managers, to ensure that they're enhancing their returns from their investment, especially in range-bound markets. Institutions do it because they get their own advice and they get broker advice that says, well, this stock is actually a sell when it gets up to a particular level. It might be a resistance level on that particular stock. And it allows you to preset sale prices but get paid by the options market to actually sell at those levels. So if you were to preset your sale price for shares, similar to the way that you would go ahead and limit order just to sell shares with your broker, you could actually place a limit order via the options market of selling an option at that strike level, but actually get paid by the options market to do it. It does provide some limited downside protection, but it's not the reason that we do the strategy. It's all about generating income streams so you can enhance your total return on the stock over and above dividends, or even turn a low-yielding stock into a high-yielding stock by this strategy. Importantly, though, we should only use it when we are neutral to moderately bullish. And I know Ivan and Patrick talk a lot about looking at those charts. You should only do it when you think the market is range-bound. Don't want to do it on a stock that's a takeover target or could fall significantly because you could lose overall on that trading strategy. So if we're thinking about the strategy itself, you have to agree to sell your call. So it's no good going and selling a call option. All of a sudden you get called away and say, look, I don't want to sell my stock anymore. We have to agree to sell our calls or our shares at the call price. And generally that will be above where the share price is trading. We're going to select an expiry date of when we're going to be obligated until. Importantly, I don't know what's going to happen in the market tomorrow, let alone what's going to happen in the market next week, the week after, or 6 months down the track. So you want to shorten up the time frame. Anywhere up to 3 months is what you're going to be obligated for with the trading strategy, and we're going to receive a premium for being obligated in the marketplace. So the example that we used back in September was with Commonwealth Bank. Shares was trading at $78.30. what are they trading at today, Patrick? I think about $1 higher, around $79.30. I think CBA closed out today.
I was not watching CBA today, sorry.
Okay, I think it was around that level. But let's say our outlook was neutral to moderately bullish on Commonwealth Bank. So that was back in September. So let's say we were to sell some September $83 calls. Let's say at this point in time we're going to sell some December or even some November $83 calls at 14 cents. You still, in that particular case, you had a significant increase in the value of the shares that you would still participate in. As I said, you're going to sell these calls above the market. So in this case, the market's still going to rally $4.70 before you're going to be asked to sell your call option. $9.30 today, it's still going to have a $3.70 increase from today's share price. Let's say you were to short those 5 December calls, you were able to receive, say, 80 cents in that particular transaction. That's the income that we want to receive from this trade. So we own the shares at $78.30, which was our example back in September. The very first thing that this trading strategy does for us is it reduces our break-even. So we click again, reduces our break-even down to $77.50. We've taken in that 80 cents from the options market rather than adding to the costs of our portfolio. It actually reduces our costs. So we can have the market fall to $77.50 in that case before we lost money. In today's market, we're talking $78.50. However, if the market does rally, click on that next bullet point. Our maximum profit back in September would have been $8.50 per share. So we would have sold those 5 December $83 calls, participated in the stock profit, kept out 80 cents in premium, still had a fairly healthy profit from an increase in Commonwealth Bank's share price. The levels that you're going to be looking at for writing these calls are probably around the resistance level lines that Patrick and Ivan often talk about when they're talking through these particular sessions. We click on the next slide. So let's say at expiry the stock did rally above $83. Your options will get assigned. You'll have to sell those shares at 83, get to the 80 cent premium, but even if the stock rallied to 90 or even $100, you still have to sell them at 83. Brings us to the next major trading strategy that we often see people utilizing, seeing the cash that you actually utilize is being used to actually protect themselves against a cash covered put. So people actually then go and sell puts to try and pick up stock again, use the cash that they've received from that exercise to benefit. So they're rolling into another trading strategy. If the market was to fall, however, our option premium that we've received does only give us a limited downside protection. So you're only going to do this on a stock you like. If Commonwealth Bank was to fall significantly, we're only protected by 80 cents. You would have been better off purchasing put protection on Commonwealth Bank if you think the stock's going to fall further. Slide. So we do get benefits from selling these call options. In this particular case, 4% per annum on the trade that we've seen just before, or $3.20 per year added over and above dividends if you were to do this that few times a year. It does provide that partial hedge, but please don't do the trading strategy for a hedge. It's all about income generation. You do have risks. If the stock does rally significantly, it is going to cap our upside only neutral to moderately bullish markets, and there is downside risk if the stock does fall. So hopefully that's given you some quick understanding of the two most popular trading strategies, but as I said, people are starting to roll into that third one where they might be selling some puts over some of the cash that they've generated if they had to actually sell that stock. So I'm sure Patrick and Ivan, you've got some stocks out there that you might want to see some covered calls over at the moment.
Yeah, so I mean, look, I guess interestingly enough, when we last caught up, Graham, you were mentioning that a lot of the fundies are actively using these strategies, but in some instances they use it, they're happy to get exercised and will sell a put straight away if they get exercised. Is that right?
Yeah, that's right. They have target prices where they're happy to sell stocks, so they'll sell call options at those particular levels. Then they'll have another target price immediately where they're happy to pick up the stock, so they'll sell a put at that level. So effectively, they're just trading those views that they have of where they're happy to buy and sell that stock. When they're happy to sell, they sell the call when they own it. If they don't own the stock, they'll sell a put where they're happy to actually pick it up and buy it. So actually using the options market to help with their inventory even within their fund.
Yeah, so they, for example, if they thought that Coles was fully priced at $16, they'd be selling up at $16.
That's exactly right. Sell up at that $16 mark.
Yep. And then they might be happy to get back in at $14 or something like that.
Yeah, spot on. So once I've sold that call at 16 and I've been caught away, I might go and then write a put at 14, pick up some more premium. But then if the stock does get down to those levels of expiry, then I pick up the stock where I'm happy to buy it anyway.
Do they generally, are you seeing the strategy just applied in a really sort of regimented way where you sell the call at that level, you keep selling it, unless something changes about how you value the stock, you leave it there, and then if you get exercise, you immediately write the put, or would they wait for the stock to come off, or is it a mixed bag?
So it is regimented. However, they're taking a new opinion on the stock every single time something happens in the market. So it isn't just assumed that they'll write that put. However, they will look at that stock again. Is it something that we want to own within our portfolio? If that decision is yes, they'll immediately write the put. But it's always about what do they want to own in their portfolio driving their decisions when it comes to the options as opposed to the option strategy.
Yeah, okay, good. All right, well, look, we've seen it definitely over the years being a really popular strategy with some of the more sophisticated portfolio managers that we work with. But these aren't complex strategies. They're very, I guess once you understand how to place them, the actual application is fairly straightforward. And, if you really believe something is fully valued at that level, the worst case scenario is you generate income and then you end up selling it at a higher price than what you were holding it at that point in time if you were selling a call option. And on the flip side, if you're selling a put at $14, if you think it's worth $14, you get to generate a premium. You might, the share price might go up. You might never own the stock. But if it does go down to $14, you'll get exercise. You'll end up owning the stock, but you'll end up owning the stock at a price where you take off all the premium that you've generated. So if you've generated all the premium, your real purchase price is the equivalent of $13. So yeah, it's a strategy
that butt in there. Just to butt in there as well, is that the next month that it expires worthless and you put it on again and again and again and again, it just keeps improving your price. That's the big thing that, you're effectively, because you're obligating yourself to buy the stock at those prices. Like a limit order you can go on and cancel, but if you don't intend on cancelling it, you're effectively going to get paid for that obligation. So, and every single month that it doesn't get hit, you're still winning.
Yeah, absolutely. All right, guys. Well, we've covered a bit of territory. There's been a couple of questions, but are there any other questions that you would like to ask us? We're happy to talk about anything. You can ask Graham any questions you'd like while you've got him here to cover anything at all, or for ourselves, or any questions that you might have about the game. So please, if you've got a question, type it in. But if we don't see any questions come through in a moment, what I'll do is I'll call a question to a halt. We'll get the recording out. You guys should be getting the morning updates. On the morning updates, you'll see some comments about trading ideas, and you'll get the market updates. And we'll be also putting all the webcasts that we've got coming up in the coming days. All right. Do you want to just ask that question?
Sure. Ivan, were you planning on discussing something just at the end of this session?
It sounds like it's already been covered. I was just going to talk about cash secured puts and covered calls, but it looks like that's exactly what you guys are talking about, which is great. That's exactly what I was going to talk about. Yeah.
Too easy.
Beautiful. Okay, guys.
Yeah, it's been something. It's just really 2-second summary on that is that it's just been something. I think it's come up probably about 10 times. A lot of people that have been coming into the options game have seen somewhere that you can generate extra revenue into your portfolios. Big fund managers, the Warren Buffett type kind of players have used these kind of strategies in their portfolio. Just look up Warren Buffett Coca-Cola trade. It's probably his most famous one for doing this. Last game, from memory, Patrick, you had one of the fun guys from Armitage come over. They spoke about how they use these strategies. Sophisticated traders do this, and anyone who's ever read about this always goes, oh, this is really cool. The reality is everybody should be looking at possibly taking this into their portfolios it's a very easy way to implement options and improve their overall returns.
Absolutely. So if you've been playing the game or testing out the platform and you would like to actually open an account and trade with us, just type in yes. Some people want to trade with a full service broker. Some people want to trade online. Some people want a combination of both. Some people want access to trade ideas. Some people want to be able to backtest their trade. Everyone's got different needs. From our perspective, we just want to be able to help you trade options and get access to the best technology and all the support that you need. So we can help you in whatever way you need, whether it's having a full service relationship, whether it's talking to Tim and getting some education and support, whether it's just trading online. Our brokerage rates are $24.95 per leg, and we allow you to do multi-leg option strategies, and I believe we're the only broker that allows you to trade online in that manner, so you can really keep your costs down low. So if it's something you're interested in, type in yes into the chat box and we'll organise you a trial beyond the game. And for anyone that uses our platform, we put $50,000 into fictitious dollars into your account so you can continue to practice trade everything that you're doing beyond the game as well. So look guys, hope you've enjoyed today. That's it for this week in terms of the educational webcasts. Oh no, we've got one tomorrow, sorry. We've got Trade Group tomorrow, so it will be interesting to see what happens overnight. If we see the market going up further, we're going to have some of our breakout trades will be lining up. So that will be an interesting session tomorrow. That will be at midday tomorrow. Tim, you're running that session. Ivan and I will try and dial in, but we're both on the road tomorrow, so we'll be dialing in from our phones. You'll be holding the fort here. So guys, please come along to that session. Come armed with any questions or any trades you want to discuss. Happy to price up while the market's open trades, or look at trades you've been doing, or answer any technical questions you've got around the platform. All right, guys. Well, thank you very much for coming along and joining us tonight. I hope you've enjoyed it. Graham, thank you very much.
Not a worry.
And Ivan, and we'll call the session to a halt. Thanks, guys. Have a wonderful night. Bye-bye.
Thank you.